All right, so welcome back to um, accounting, right? We are in the middle of chapter 5, but let's go ahead and do a review because we're dealing with periodic inventory and we're going to deal with the purchases section, okay? So again, merchandising inventory is our main course right here because that is what our business activity is, right? We are looking at a merchandising or a reseller's standpoint of a business where we are purchasing inventory that's already made, right? So we're buying goods, and what we do is we either personalize, customize, or add something to our products, and then we resell them out to the public. Okay, so that's what we got to do. We're gonna take our cash, convert them into goods by purchasing them, and when we purchase those, we're going to convert those goods into sales, and then we collect those cash from our sales. Okay, so that's the idea of what we are doing and what inventory is, because this is something that we should keep track of, because if it's part of our main core of operations, right? If we're trying to make money off of selling a product, right? Best way to keep track of it is through inventory, okay? So these types of businesses that are that you would commonly see would be any typical retail store or someone who sells in bulk, which is a wholesaler. Okay. Now, what are the total cost of making a purchase of inventory, right? What are the costs, right, in order for us to actually successfully obtain inventory items, right? What costs are going to be including in the price of the cost of goods sold? Now, in this case, right, we have to consider a lot of different factors, right? First one, obviously, is what is the purchase price that you are actually purchasing the items at? Now, most commonly, right, if you are purchasing it from a manufacturing company itself, you are purchasing it at its cost value, okay? What those manufacturing companies are selling it to you at. And usually it's significantly lower, right? Now, this cost, right, can include things like such as sales tax, right? Most companies, right, when you do become a small business and you are a retail business itself, sometimes some manufacturers can tax exempt you. All right, so that it is a common business trade-off, just because again, instead of collecting sales tax from you as a retailer, right, you're going to be collecting the sales tax for them by selling the product and collecting the sales tax. So you have to be responsible to pay the local state and governments, right? The city governments that need that sales tax money. So that's why they'll tax exempt you. But sometimes if you are a small business, they might not trust you right away, right? You might be a growing business, so they might not tax exempt you for the first couple of purchases of inventory. But I believe most cases, if you can prove that you provide your business license and that you are in fact a retail store, usually the items that you purchase, your inventory items, are usually tax exempt. Okay, but sometimes, again, if you have to run to the store because you ran out of coffee cups or something like that, if you have to go to a different store, right, you are subject to have to pay sales tax. Okay, and that could be part of your inventory. So again, at the end of the day, if you have to, sometimes you have to be charged sales tax, and you have to take that into consideration as something that's going to be part of the cost of the inventory. Okay. Other things such as shipping and handling, also known as freight expense, right? Freight could be something that we consider as shipping from one store to another, right? Other things could be shipping costs, like maybe handling. Maybe it's fragile things, so you have to pay a higher cost and value to ensure that those inventory items do get to you safely. And maybe things like storage fees. So we did talk about other operating activities, right? You can actually you can't actually include the storage fees as part of the cost of inventory, right? Things like other things could be like expedited, right? Let's say you need the inventory items now, and for express delivery, they charge a higher shipping fee, right? That's going to be something that is going to be included in the price of inventory, right? Things like foreign costs too. If you have those items being purchased overseas, right, they might charge you that extra fee for foreign costs, okay? So there could be any extra things, because the idea is that whatever cost it takes to get those assets or those inventory items to your store is going to be all included in the price of the inventory, okay? So that's what we have to understand, is it's not just simply what it costs me to purchase it off the shelf. It's everything included to get those inventory items to my store, okay? However it gets to my store, okay? So here is an example of a situation where who is going to be responsible for actually paying for the shipping costs, right? Because in this case, right, we only see it when we purchase our inventory items, we only see it as a one-way transaction, right? They may charge us for shipping, right? That is because they're charging us to ship it from their store to the midway point, right? And then the business has to cover the other half of that shipping cost to get from the middle point all the way to your store. Okay, so in this case, shipping is actually a two-part cost. Even though they may charge you for shipping, you're not covering 100%. You're only covering for your part to get it from the store to the middle section. Okay, and then the rest is responsible for the company to pay for that charge. That's why oftentimes, right, you go to FedEx or UPS and you're shipping out something small, it costs $16, right? That's because it actually only costs you $8 to ship it from yourself to the store, right? But in this case, they also have to take that extra cost to ship it from their location to the designated location. So that means that's why they're charging you $16 opposed to, because they want you to cover all of those. But at that point, you already traveled from yourself to get to that store. So that's the cost you already incurred already. So in this case, that's exactly why shipping items, especially overseas, cost so much money. Okay. Now there are two types of shippings that you are going to be we're going to be utilizing in this class, which is FOB, which is freight on board, and COD, which is cash on delivery. So yes, you can have a company ship out items to you through a third-party vendor, and that third-party vendor isn't a part of the company itself. So think about Amazon, right? Amazon, now they have their own Amazon trucks, but they actually were sending things out through FedEx and UPS, right? They used UPS and FedEx as a third-party vendor to get those items out to those to the designated location. So they're paying FedEx and they're paying UPS to ship those items out, while you just pay the cost for them to ship the stuff out. So again, it's a two-way transaction when it comes to shipping out items, okay? You just have to know that when you are in the process, you are responsible to pay for FOB shipping point, which is paying to get the items from the seller's store, okay, to the midway point. And once it moves from the midway point to the buyer, which is you guys, right? The company is responsible to pay for that shipping, okay? That's how we have to understand shipping and why it costs so much, okay? And how is ownership transferred, okay? Now let's talk about inventory tracking methods. So again, for Chapter 5 and Chapter 6, we are looking at periodic inventory. Chapter 7 and 8, which is after the exam, which is going to cover perpetual inventory. Okay. However, you guys should know at least the ideas, that there are two ways that you can keep track of inventory, okay? Periodic inventory is where you, again, the definition of periodic literally means you're going to update it or keep track of it occasionally, right? Periodically, right? You do it every once in a while, right? It's not constant, right? You check on it every once in a while, okay? Where perpetual, right? Perpetual. Think of what do you call it? A swinging pendulum, right? It's constantly moving left and right? Because it's in perpetual motion where it's constantly moving. So that's the same definition here. If you look up the definition of perpetual, it means constantly, okay? Meaning you're going to keep track of inventory on a constant basis, okay? So let's start with periodic first, right? If I'm looking at something periodically, right, it means maybe these items isn't something that you constantly sell so often, right? Because the main idea is that if you're buying 100 cups and you know that's an item that you don't actually sell often, then at least you don't have to keep a good close track record of how many cups that you sold, because at the end of the day, right, it's not an item that you sell all the time. Maybe every once in a while you'll sell that item. So in this case, you don't need to keep a close track of it. So that's why we say periodic. And what we do is, here is the key factor. Usually with periodic inventory, since you're not keeping a good track record of it, at the end of the accounting period, okay, whether it's at the end of the month, it doesn't have to be exactly an accounting period. It could be something that you do cyclically. So again, if you're just only keeping track of your inventory and you're checking it up, usually there's a physical count at the end of the given accounting period, okay? And once you do that, then your assumption is, if you didn't really keep track of the sales in the first place, is that whatever amount that you have in your inventory is going to give you the assumption, right? If I purchase all this inventory, that means if I end with all this inventory, I must have sold those inventory along the way, okay? So that's the idea here, is that when we have periodic inventory, usually you don't keep track of it or you don't check on it until the end of the accounting period, okay? And in this case, right, this is what we have to do. Very key important is that for periodic inventory, we recognize all of our purchases as expenses, okay? We keep track of our inventory as expenses, okay? Because we're making an expense for the company, right? It's an operating expense that we have to do in order to operate our business. So that's why for periodic inventory, since you don't really keep track of it, best way to understand the difference between them is that you are going to identify them as expenses first, and then when you reach the end of the accounting period, then you do your conversion entry, okay? Where perpetual inventory, right, since you're constantly updating and keeping track of your inventory, you are going to keep track of every time you make a purchase, you need to update your inventory. Every time you sell an item, you need to calculate it out from your inventory. So you're constantly updating, so you will know how much items you should have on inventory on hand at all times. And the difference here is, when you're dealing with perpetual inventory, since the idea is you're going to continuously update inventory when you purchase it and then update inventory when you sell your items, you're going to recognize them as an inventory asset account. Okay, so that's the huge difference here. Periodic are expenses, perpetual inventory asset. Okay, but because for this sake of class, for chapter 5, we're only going to focus one section at a time. Okay, so we can kind of understand how one tracking method works, and then go ahead and introduce the second tracking method afterwards as soon as we understand the first one. Okay, so we're going to only focus on periodic for chapter 5 and 6. Okay, so periodic inventory. Okay, so periodic inventory purchases. How do we purchase inventory? Well, for this example here, XYZ company, okay, they decided to purchase 100 units of toys, okay, from a company called Toys R You, okay, Toys U. and it cost $5.65 per toy, okay? And you have freight costs of $100, okay? Purchase was made on an account, okay? So here's some terminology you need to know. And so let's go ahead and record this transaction. Now, when we're looking at this, right, we talked about what are the costs of inventory, right? For this class and for this class only, I'm only going to teach you one extra expense account, and that is the freight expense, okay? We're just going to assume that there's no other extra charges, other extra cost for purchasing inventory, right? But please do not confuse this. This is not the only cost you would occur with periodic inventory, right? We've already listed it earlier, right? If you have to pay for sales tax, you're gonna have a sales tax expense. If you have to pay expedited shipping fees, you're gonna have to put that under another cost, right? Postage fees, right? Those are going to be extra costs. But for this class, I'm going to keep it really plain and simple because we need to understand the very basics. We bought our inventory, so purchase expense, and here's the shipping cost, the freight cost, so we'll have freight expense, okay? So how do we do this? Well, since we established those two things, they're both expenses, so since we purchased, right, we're increasing our expenses. So in this case, we need to calculate what those 100 toys are at $5.65, right? So that means my total purchase expense, right? Using the monetary assumption, right? Where our values, when we record them in our journals, they must be in terms of value, not quantity. So in this case, I can't write that I'm purchase 100 units, right, in my debits and credits. I have to do it as a value, a total cost. So in this case, I spent $565 just to buy 100 toys at $5.65 each. Okay. Then, because we already know what shipping is, right? It says right here, freight cost was $100. Therefore, we need to separate our expenses out with the separate shipping cost of $100. Okay. And of course, because we place it on an account, meaning I never paid for it, I have a credit account with this vendor, right? They're gonna bill me later on. That means I owe this vendor, right, a grand total of $665. And yes, $665. Okay, and that's how I record a purchase. Okay. Now, of course, when it comes with purchases, we also have to deal with discounts because usually even your vendors will offer discounts to you, or vendors will have a special sale for you. So when they do have that, you're going to be if you are going to be taking advantage of a purchase discount, this is how you're going to do it, okay? So purchase discounts. Usually, typically, when you have these opportunities of a purchase discount, right, we understand them as terms, okay? Terms, as you can see right here, is a 2%, 15, net 30. What does that mean? That means the vendor is going to offer you an incentive, okay? And what is this incentive? This incentive is that, hey, I'll give you a discount if you pay me within a certain time period. If you don't, then, whatever you owe me is what you owe me, and it's going to be due in exactly X amount of days. So in this case, right, how we read this 2%, 15, net 30 is the vendor will give you a 2% discount if you pay them in full within 15 days. If not, the entire bill is due within 30, okay? Now, if you remember remember me talking earlier, right? Usually when you have vendors like these, right, and they give you accounts, right? If you don't have a negotiable financing, right, if you're not making a monthly payment to them, then most cases they'll give you a bill and it will be due in a certain amount of days upon receiving the bill. Usually it's 30, 60, 90 days. Okay, that's what are the most common ones. So in this case, that's exactly what they're doing. So in this case, this vendor is not going to do a financing with me. They're not financing with me. They're going to give me my order, right? And they're going to give me a bill saying it is due in X amount of days. So that's exactly what this is here. Now, again, they say, hey, but we will give you an opportunity to take advantage of a discount. We'll offer you the 2% discount if you pay within 15 days. If not, then your original bill is going to be due in 30 days. So that's where us as a purchaser is going to either pay within the time or just pay in full at the end of or just not be able to take advantage of that discount and just pay the bill off in full within 30 days. Okay. So in that case, then, how am I going to record these purchase discounts, right? You have the net method and the gross method, okay? Net method, right? Think of it like your paycheck, right? You have your gross income or your gross pay, right? Which is everything that you earned before taxes. And then your net pay is your amount that you earn from the company after the taxes. Same idea here, right? Your net method is going to have you record the purchase after the discount, okay? While your gross is you're recording it and then you take the discount when you pay, so you record the discount actually later. So that's the idea here, right? Net means now, take the discount now. Gross means take the discount later, okay? So if you've gone through this, right, the gross, right, this typically, when you are a small business, you generally should, record all your transactions as gross. Why? Because you might not have enough money to start your business, or the expenses that you have, you might not be able to pay right away just to take advantage of a discount, right? You also have to consider, right, what are your other priorities? What are the things in your operating expenses that you have to pay first? So usually a rule of thumb is you should always pay your employees first, right? You should always pay the rent first, okay, before paying off your inventory. So in this case, gross method is recommended for a smaller business that not quite sure if they have enough money to just be able to pay off all of this and also be aware of their, other expenses that they have to pay first, okay? So again, what we saw earlier is the same example here where we're recording it at full price value, okay? So here we owe a total of $225, okay? However, if we're using the gross method, let's say we do pay within the discount period, right? Then you're going to create a contra account called purchase discounts, right? Which is going to go against your purchase expense, right? That's what a contra does. It decreases either the main or sub account. In this case, purchase expense is going to be a main account. So here you have a contra account, purchase discounts to be able to decrease the purchase expense, okay? Rule of thumb here is you cannot undo a purchase or cannot undo an expense, right? We understand that because it's like, again, you paid for rent. Can you undo that? No, you can't. You already spent the money. So that's the same idea, and that's why we have to create a contra account so we can reflect that we, instead of going back and editing everything, right, we're going on forward and we're adjusting as we go. So in this case here, that's what the contra account does, is that, because I already recorded it at full price, this is the adjustment that I need to incur, right, the contra account, the purchase discounts, to decrease my purchase expense. Okay, so there you go. You create a contra account. Even though you owe $225, right, because you paid within the discount period of that 10 days, right, you paid on the 9th, one day before your discount period is over, you are not going to pay in full. You're going to be paying the discounted price. And there you're going to also record that purchase discount to reflect that discount that you took. Okay? Right? And then, of course, for the gross method, let's say if you didn't pay and you paid after it, then you just pay what you owe, right? The full amount of $225. Okay. Whereas the net method, what you're going to do is if you're really good at paying your bills on time, then go ahead and use the net method. Or if you know for a fact you have plenty of money in your checking account to cover all of your expenses, and you definitely know that you can afford to pay your vendors immediately, then go ahead and use the net method, okay? That way you could save yourself a journal. Instead of having to adjust for that discount, you're going to record it at the discounted price right then and there, okay? So therefore, hence the word net, right? You take the discount immediately. So in this case, instead of recording it at full price, you're recording it at discounted price. Okay, so that means you only owe $218, and of course, the day that you pay it, if you paid it on time or you paid it the day after, then you just pay for what you recorded it as, the discounted price. Okay, but let's say you forgot about making a payment on time, right? Then you're gonna have to record a contra account, because in this case you missed out the opportunity on that discount, right? So this is a contra account because you already recorded it at the discounted price. But because you missed the terms, you missed the discount due date, right? And you're subject to have to pay in full, you actually have to revert that discount that you took originally and have to put it back into the purchase expense. How? By creating a contra account. So if a purchase expense has a debit and a purchase discount is a credit, a contra is going to do, again, another flip side. So in this case, this is going to debit your purchase expense, because in this case, you missed out on the opportunity of taking that discount, but you already recorded previously as a discounted price. Okay? And then that is it for chapter 5.1 and 5.2. Okay? All right. Now the other section is the purchase returns and allowances. So yeah, of course, when you have the opportunity, if you can take a discount, right, and you make your purchases of inventory, right, what is next? Well, you also have the opportunity to also get a refund or a return for products that, for in case, like when you get shipments of products, right? What happens when you buy it and it's not what you want, okay? So purchase returns and allowances, right? Oftentimes, because the idea is that you're trying to resell these products, right? If the vendor decides to ship you out items, right? Again, they're shipping out in large quantities. It's a common mistake that every business does, right? Every business will make a mistake at some given point. So they could be shipping out the wrong items. Some of those items can be broken due to shipment, right? Maybe the UPS person wasn't being careful and they threw your shipment over, or they, dropped it or something like that. Things happen, right? So they could break your items, or you could test your products to make sure that they work before you sell them and find out that they sold you defective items, okay? Again, there are many reasons that vendors can send you merchandise that just isn't good quality, or it's just the wrong item, okay? Another one could also be too is customer service. If this person just doesn't seem to care about your purchase orders, or they make mistakes all the time, or just their service is just not up to par, then of course that could be a reason why you want to request a refund or an allowance for purchasing these items from these vendors, okay? And of course, because it is a vendor to customer relationship, right? They are providing the items from us. They are the manufacturing company that we as a retail person is purchasing from. So because their end goal is to sell their products and have us sell them out for them, right? We're purchasing in large quantities. So therefore, because we are doing that, right, the main goal of a vendor is they also want to satisfy you, because you as a purchaser, right, is going to be their main business, right? Because we buy in bulk. We're buying hundreds, pallets. Like again, we're buying more than one unit of item, right? Because our main goal is to sell those items for these manufacturers. So in this case, they will do anything to keep your business. So whether it is, giving you special discounts, giving you special offers, or even giving you a full guarantee money back, or unlimited exchange, and so on and so forth, right? These vendors are willing to make that sacrifice and keep you as a business because you are a main chunk of their business. Okay? So that can include all of those. So again, when we do come across some purchase returns, right, our main deal is to ensure that, when we do purchase our items, okay, so here we purchased our items, we received them, okay, but then at the end of the day, right, we end up having to return 10 of them because they were broken, okay? They were broken due to shipment. So again, as a retailer, you can't sell broken items, and you paid for 100 of them, and they end up breaking 10 of them due to shipment. So that's not fair to you as a customer who's trying to sell these products out. So you can request your vendor to give you a vendor credit or a return, in this case, a refund. So in this case, because of their company store policy, they decided to give you a full refund for the broken items. So once again, how do you calculate that? Here's the rule of thumb, right? If you chose to pay on an account, that means when you receive the bill, you didn't pay for it yet, okay? So in that case, how is a vendor supposed to give you your money back if you didn't even pay them? The one is they can either keep it for a future purchase, or they can offer to take it off of what you already owe them, okay? Now, most cases, that's what we're going to understand, is that they're going to take it off of from what we owe them, okay? That's how they're going to reimburse us for that. And we have to create another contra account called the purchase returns and allowances, okay? Because once again, purchase expense cannot be undone, okay? So in this case, we have to do a contra account to reflect that, hey, we may purchase 100 coffee mugs, but at the end of the day, we end up returning 10 of them. So at the end of the day, I have a total of 90, not 100. So I have to create the purchase returns and allowances, right? This is a full refund. So this is a full return, okay? So how are we going to calculate this? Now, notice this. Why am I only charging at $1.25? What about the shipment, okay? Shipping is a separate cost to your business, okay? You accepted that you're going to pay an additional $100 to get these coffee mugs to your store. So that is a separate cost, right? That's not what you originally purchased it for. Okay, so that's what we have to understand, that you can't return shipping, right? And again, I talked about this in the previous recording. If you go to UPS and say, I want my money back on shipping, they're going to laugh at you, because that's not how shipping works, right? You don't get to demand a refund for shipping for any reason, okay? So in this case, that's the same idea here, right? You can't get your money back for shipping because that was your cost that you have already incurred to get those original 100 cups back. Most cases, the vendor usually will, if they want you to ship the items back, they most likely pay you to ship those items back. Or for most cases, like they have a, a relationship between the UPS, FedEx, whatever shipping agency that they used, right, to just accept those packages without charging, okay? So in this case, we cannot calculate the extra amount it costs me to get those items to my store. So in this case, I have 10 broken coffee mugs. Now, are they going to request those to be shipped back to them At that point, what is broken coffee mugs going to do for that company? Probably nothing, right? They're not going to glue them back together if they're broken. So in this case, they might not have you ship them out. So, but in this case, right, I have to understand how much did they originally charge me. They charged me $1.25 per cup. So that's the only amount that I'm actually able to get a refund for. Okay, I cannot include the shipping. So therefore, I'm going to get a total of $12.50 back as a refund. Okay. Yes.
I have had an experience that from Amazon I received something and it wasn't what I was expecting.
Mm-hmm.
So when I contacted them, they said don't even bother sending it back, but just keep it, but we'll give you a full refund.
Mm-hmm.
So for the Amazon side, they do the same exact thing on their end, as if
Yes.
I'm returning to them.
Yes, absolutely. Because sometimes maybe the cost isn't worth it. So oftentimes, if you buy something that's like $6, they'll be like,
Yeah.
"What's the point of you shipping it back to me?" They'll let you
Yeah.
even keep it, even because it's not good to them either. Because if it's broken, what are they gonna do? If it's something that you bought that was significantly very very cheap, they're not gonna
Yeah.
want it back.
No.
Okay, so that's their way of doing good customer services. Is hey, you know what? I understand that the item is broken. Keep it. Or sometimes what they used to do too is they usually say, "Oh, the items are broken. Send it back, and I'll send you a new one." That's
Yeah.
another topic for another time. That's where you do a
Okay.
full exchange. But in that kind of
Okay.
case, right? Yes,
Yeah.
it just really depends on what company you're purchasing from.
Okay. Thank
Mm-hmm.
you.
So again, if that was the fact, right, they could ship you out a new one, but they might require you to ship those old ones back to them. Maybe they could resell them if they sent through the wrong item. Most cases, what they do usually do is they say keep it and we'll send you a new one. It just depends on what the company policy is. Okay, so yes, all right. How about this instance for this example right here? Okay, where I purchased some items. Right, we purchased a total of the cups again, 100 of them, for $1.25. Right, but this time 20 of those coffee mugs were the wrong size. They accidentally shipped you out someone else's order and packed the wrong order and shipped you the wrong items. They gave you the extra large cups instead. Okay? Now, as a vendor to retail relationship, right? Because here's the thing, the vendor is willing to work with you for whatever reason that they need you because you are majority of their sales, right? So if they accidentally send you something else, right, they can have the option to either let you keep the items and they'll give you a discount because again, that's not the product you want. You wanted a different product. So what they usually do is they'll say, "I'm so sorry. I'm going to give you a discount on top of that because I know I sent you the wrong items. Here is my way to keep us having good business with each other, but also give them an incentive for you to come back because they'll say, "I'm sorry, I sent you the wrong items. I'll give you a discount on top of that." Since they're not technically you're not returning the product, right? You're keeping the product. And because they sent you the wrong items, they're apologizing and they're hoping that by you accepting this discount or just keeping the items in general, right? You'll continue doing business with them. So in this case, they decided to give us an additional discount because hey, maybe they say, "You know what? I know that you bought these regular size coffee cups, but at the end of the day, the extra size coffee cups, you could still sell them." Right? There's nothing wrong with them. They're not broken. You could still sell them. So that's the idea with a vendor to retail store relationship can be is that I'm sorry we sent you the wrong product, but if you want a refund, we can issue a refund. But if not, they can also convince you to say, "Hey, you could still sell these items at the end of the day, and you could charge whatever price you want to charge them. But we'll give you a discount because I know we shipped you out a fourth of the items were actually the wrong size. So that makes you have to order more." So in this case, they will apologize for that and send you a discount for making that mistake. And that's going to be considered an allowance, right? You're not getting the full refund, right? You're keeping the products, right? But in this case, right, the allowance is you're getting a portion of that money back. That's the difference. Now, returns allowance and return and purchase returns, usually in most cases, in a business standpoint, they are separate accounts, but they both function the same thing, right? Because it deals with the product being returned or you're getting a portion of that money back. And that's what the allowance section is for, is you're getting a portion of that money back. Okay? Because in this case, they wrongfully sent you 25 of the wrong size cups, but you were willing to accept it because you're right. There's nothing wrong with these cups. I can sell them. And they discount you for that to reprimand their mistakes. So in this case, I can only discount the wrong items, okay? Because in this case, I'm attempting to return the items, but not really. So in this case, I can only calculate the 25 mugs that I was wrongfully charged for, okay? Or wrongfully shipped, right? And I can only take a discount off of that. Okay, so that's where you have to understand how the allowances works here. Okay, and then chapter review, right? There you go. All right. So any questions in regards to the chapter 5 review? Okay, so that's everything that we're caught up to.